Hey everyone, Paul here, and this is the first guest that I've had on the Taking Stock Investing channel. And this is a guy I connected with on social media, Adam Fiore. You can go to adamfiore.com. I'm gonna have the link below. But this is a guy that's managing a personal portfolio over $1 million. He has an investor group where you can kind of get involved with that. But it's just, it was a good conversation. I think you guys are gonna be able to learn from this. I'm looking forward to staying connected with Adam. Looking forward to having other guests on the show. If you would like to be on the show, let me know in the comments below. Love to connect. And if you want to see future interviews like this, go ahead and like this video, subscribe to the channel for more videos like this coming. But let's get into the interview.
Paul,
Hey, good. Are you, Adam?
I'm great, man. I'm great. Thanks.
How's your Sunday going?
I can't complain, man. It's going pretty good. I'm just taking care of some business, and I like to kind of mix just work and relaxation. I like what I do. So, I always do some work on the weekends. How about
Okay.
you?
Gotcha. No, yeah, it's going well. Same kind of thing. I've got a full-time job, but when I'm able to make time, I like to be able to put in the time for stock research and make connections. So happy to be spending this time doing it. And yeah, no, like I said, I feel like I'm excited to have you on. I feel like
Thanks.
I certainly, want to offer for my viewers kind of where I'm at, and I try to be honest with that. But certainly for have somebody like yourself who's managing, a portfolio north of $1 million, I'm sure that you've got a lot to offer, for some hurdles that I haven't kind of gone to yet. So I think that's exciting. And again, I was kind of hoping if you could kind of give an overview of kind of the fund that you have and kind of the value you bring, if you want to give a brief overview about that. And I'll have a
Yeah,
link in the description below.
that sounds great, man. I'll what I can do is I can talk about, so what I offer is a subscription membership. It's education. I don't manage anybody's money.
Right.
It's all I do is I share my well, two things. People that are become members of my membership, they get a course, an online course where they actually learn the story and the steps that I took to go from someone who literally had no financial background, no financial education, and was just had my money being managed by a financial advisor and mutual funds and ETFs and that bonds and all that stuff, to becoming someone who actually self-educated myself. I fired my financial advisor and started managing my own portfolio. And it's a much higher risk. It's a high growth tech stock portfolio. All of my money is in stock. I'm
Okay.
really comfortable with that. I don't have any money in bonds or any type of funds.
Yeah, I think it's
And
about being aware of the risk trade-off and things of that nature. Absolutely.
absolutely, yeah, I've been very well. I employ a risk mitigation strategy, and I can't really get into the nuts and bolts of it when we talk, but I can kind of talk about it, And
Okay.
I use a risk mitigation strategy that has allowed me to benefit in 2020 when the stock market crashed, and even can already start seeing it benefit now from the recent tech sell-off. So yeah,
Good.
I mitigate my risk in other ways as opposed to the traditional bonds and funds, type of
Okay.
thing. So yeah, we can talk about that, and then and then yeah, so and then the other pieces to what my members get, which is like real-time email trade alerts. They basically get to follow the trades that I make. They make them themselves if they want to, or they just learn. Some people make some of the trades and some people make all the trades. Some people want to mirror my exact portfolio.
Yeah,
It's really what people want, how they want to do it. But most importantly, I think a lot of people, like, we have members in 10 different countries around the world, and a
that's
lot of
great.
our members, which is cool, and a lot of the members that we have started with literally no knowledge whatsoever.
Yeah.
And I think what they get is they get an education. They at least start to understand um, why things kind of move the way they do. And, kind of like you said, like, what risk comes from doing different types of investing. And, I give them the resources that help me, and, things of that nature. So, yeah.
Okay. I'm kind of curious though. So what motivated you? So you said no financial kind of background. You're kind of outsourcing that. What motivated you to kind of become more hands-on with that?
Well, it was a couple of things. First of all, I found myself becoming more and more interested in the stock market, following it kind of like from afar and watching my portfolio.
Mhm.
Um, and uh, the other thing was back in 2018, right before I took my portfolio over, I guess the end of 2017 even, I started looking at it and thinking to myself, at the rate this portfolio is growing and the size that it is, am I going to have enough money in retirement to, to live the lifestyle, my wife and I, that we want? And the answer was, I don't think so. So I felt like I had to do this. So I started reading some different books, and, all the books that I read were helpful just in the fact that they taught me something.
Right.
But some books I decided were not my style. Some books are, and ended up educating myself. And yeah, so the motivation was just to really try to kind of turbocharge my return, so to speak. I mean, I wanted to be able to, I read about people who were crushing the S&P 500, and I wanted to crush the S&P 500. So I started my portfolio in the beginning of 2018, and it's been 3 years, and we have crushed the S&P 500 by triple digits on an annual basis, over a 3-year period of time, just pretty much any period of time you're looking at, except for the past 2 months, we have crushed the S&P 500. So yeah, so it's been a good journey.
No, and I think it sounds like even with the events and the way the market's kind of played out with tech over the last couple of months, looking back over the last 12 months, I think you're still handily beating the market, right? So
by triple digits, yeah,
exactly.
And it goes to show what's real interesting is, the tech stocks that we hold in our portfolio are very high growth, right? They were the ones that were doing the best, and they were the ones that also got hit the hardest, right? So, but what's interesting is that some of our stocks are down 50, 60% since the first week of February of 2021, right? And you would think that, wow, we must be getting crushed this year, year to date. The funny thing is we're actually up year to date. We're still up year to date, even with that tech sell-off.
Wow.
Because between the beginning of the year, January 4th, I think the year started on the stock year, or whatever. So from January 1st until the first week, until February 6th, my gosh, man, we were up, I think, like close to 30% in like the first basically 6 weeks of the calendar year. So yeah, we were able to weather this storm and still be up. And now I feel like we're really kind of hitting a groove. And again, with the risk mitigation strategy, we were prepared for a downturn, because we don't try to time the market, and we're long-term buy and hold investors. So, we've been buying for the last 6 weeks. I've been buying as recently as last week. I was just buying and buying. And interesting story. I mean, like last week, a couple of our stocks were really beat up, and I was getting messages from my members like, should we still be in these stocks? They seem like they just keep going down and more and more and more. And I was like, look, I am in these stocks because I believe in the long-term thesis of this stock. So, and if I believe in the long-term thesis of this stock and it's down 50% from where I initially bought it, well, then I love it at this price. So sure enough, we made a big buy into 6 of our stocks, 6 of our favorite stocks that we felt had like true 10x potential over the next 5 to 10 years. And we felt severely undervalued because of the tech sell-off. So we bought 6 stocks on Wednesday morning. And between Wednesday morning and market close this past Friday, they were up an average of 18%, but one of them was up 38%. It was something like 38%, 27, 20. I mean, the 2 worst were like up, I think, 5 and 8% in 3 days. I mean, so
and that's pretty good when that's your worst.
Right. And that's great. But what I try to stress, and this is my job as what I do as the leader of this Exponential Investors Club that I have, is not only to help people get exponential returns, by learning how to do it and following my portfolio. The other thing is to impart knowledge and try to keep them from making mistakes. So one of the things, for example, is we send out a weekly wealth report that they get every Sunday morning. Everybody gets the weekly wealth report every Sunday morning. It goes over everything that happened in the past week, good and bad in the portfolio, what we're looking at in the week ahead, things like that. And one of the things that I said is, look, it sure feels great to have a stretch like last week between Wednesday and Friday. It makes you feel like you're a genius. You're like, wow, I bought perfectly low and now they all went up. And that is the most dangerous thing. If you
that's what I was just going to say. When you start to feel like a genius, you got to really kind of be careful.
Even beyond that, if you start thinking that was skill, like pure skill, you are going to lose a lot of money. And so what you need to do is recognize, look, what we did, the strategy was sound.
Mhm.
That didn't mean that we knew it was going to work out in the short term. We could have bought those stocks on Wednesday. They could have went down more, and we would have been okay with that because we weren't buying for a short-term turnaround. We were buying because we believe long-term, this is a great price on a stock that's going way up. So the key is our strategy was sound and we had some good luck. You know,
Yeah.
the timing part was luck. But I stand by that. It's the strategy is sound. And that's the important part, right? Is that you have a sound strategy. You're patient, and sometimes you're going to get lucky. I think if your strategy is sound, you allow yourself to be lucky more often than not, right? You're still going to,
Yep, absolutely. And I think it goes back to what you were saying. I was reading that you were basically saying one of the biggest characteristics of a successful investor is the emotional intelligence, right?
Mm.
So it's that ability to really weather the storm, right? Because everybody's happy when stocks are going up. You know, you kind of pat each other in the back and compare returns. But when things start going down, you have like the tech sell-off, you have like the March 2020, you know, it's hard to hold on because, you know, I think when you watch something go down by 10% and then by 20%, I think like as humans, I feel like we like to project out trends based on the most recent history. So if we say, okay, wait, if it was down 10 and now it's down 20, I can fill in the blank. I know it's going to be down 30 and then 40, right? So you start to think that way, that it's only going to go down. And when it's going up, you start to convince yourself it can only go up, right? So I think having that intelligence, because I mean, it breaks my heart when I see investors, especially if they're new, and you know they panic and they get out, you know, at the absolute worst time to get out, you know. And I think that again, being able to kind of train yourself to be prepared for those situations. I mean, obviously, not selling is the best. If you have funds where you can kind of buy more, that's you know the ideal situation. But like I said, I think it's really an emotional test for sure.
It is, and a great example I can give you. This is, to me, like the most clear-cut example. It really hits home, even when I explain it to people who don't really even follow the stock market that much. Kind of makes it really let people get into how difficult it is. In theory, everybody knows that they should hold on when the market drops, or even buy when the market drops. And they should, you know, if they're going to sell, you want to sell when, you know, when you're at all-time highs, or at least trim, or whatever the case. People understand that in theory, right? But to give people an idea on how it really works in the real world, what it really feels like when this happens, I give them the example of, since I've started this Exponential Investors Club, so I have friends who follow me on social media.
Mm-hmm.
And when things were, you know, like all the way up until February, I mean, you know, for the last, literally between April of 2020 and February of 2021, the account, everything just went straight up. I mean, we were literally just going straight up the whole time. And that looks amazing. And I'm very active on social media. I want people to see how well things are going, you know, certainly, and it's exciting. And I would have friends that were coming to me like around December, January time. And they were saying, they were like, Adam, you know, I really want to join your Exponential Investors Club, but do you think I should wait? Like what they were basically saying to me was, do you really, like, you know, it seems like your stocks are almost all at all-time highs. I said, most of them are.
Yep.
Well, should I be buying when they're at all-time highs? I feel like I'm buying, you know, at a bad time. So, and my answer to that is, I don't try to give people advice. My answer to that is, I can't tell you when to buy. And I certainly can't tell you that if you buy now, the market's not going to go down soon. Mm-hmm. But I also can't tell you that if you don't buy now, price might double, and then you're sitting there kicking yourself because when you could have gotten in December and then the price doubled and you didn't. And now what are you going to pay double? You're going to keep on telling yourself it's too high. I could have gotten in earlier, right? So what I tell people is, you should be looking long-term, and you need to make the decision for yourself. If you want a dollar cost average, let's say the total you want to invest is 10,000, fine. Mm-hmm. Come in at 2,500 this month, 2,500 next month, and go that route if you want. That's not how I typically like to I believe that it's best to put it all in at one time. Mm-hmm. And the reason for that is because I think something like 3 out of every 4 years, the market, you know, I think 3 out of every 4 years that you're going to put your money in, if you're going to put your money in, the market will go up, and 1 out of every 4, it will go down. So the odds are in your favor if you're going to buy and hold long-term. Get the money in now, let it grow. And then if it goes down and you have more to, you know, anyway, point being, getting back to this is that, so I tell the people, you know, do what you feel is right. And mm-hmm. a lot of times my friends will be like, you know what? I'm going to wait. I'm going to, you know, there's got to be a pullback coming soon. And I tell them eventually there will be a pullback coming soon. I can't tell you when it's going to be.
Right. But inevitably there always is.
Yeah. Right. And they're like, I'm going to wait for the pullback. And the best thing, it's inevitable. Sure enough, in February, when all of my stocks went down, they weren't all the way down yet, but like by the end of February, they're probably down something like, maybe 20% or something. A lot of them are.
Mm-hmm.
I called a couple of my friends and I was like, hey, I'm just curious. You said you were waiting for the pullback. You love the idea of these growth tech stocks. They pulled back. What are you doing? Are you jumping in? And sure enough, they're like, I don't know. Do you think now is a good time to get in? It seems like they're going down. I feel like they're going to
Right.
keep
It's going
on
to go
going down.
lower. Yeah.
Should I wait till it hits the bottom? And at that point, I just laugh and I was like, you know what? Honestly, you probably shouldn't even be in the stock market. Now, I'm not saying that
Yeah.
condescendingly. I'm just telling you that you're probably best off just putting your money in an S&P 500 index. Don't even look at it. You're not going to get the kind of growth we're going to get long term, but you'll get some growth. And you don't have to worry about the emotional side of things. Because like you said, I mean, I have a business partner in this, in the Exponential Investors Club. She was actually one of my first members.
Okay.
She knew nothing about finance. She's a holistic psychotherapist out in Boston. She bought my course. This is back when it was actually just a course. She bought the course and then I added the membership. She bought the membership. She learned everything. And we started talking a lot and she was doing great because she learned a lot about the market and everything. And then she started helping me with the emotional intelligence piece because that's what she does.
Mm-hmm.
And we just decided, you know what, we should be in business together. She's also really great on the tech side of e-commerce and everything, which I'm not. So between that and the emotional intelligence and she's an excellent investor now. She helps us with the emotional intelligence. And yeah. So to your point, I honestly believe in emotional intelligence is as important as anything when it comes to being a successful long-term investor. I really do.
Yeah. And kind of just hearing you talk about, trying to talk to some people who said, wait, I'm going to wait until a pullback. And then on the pullback, they're kind of thinking to themselves, no, it could go lower. I feel like I really fell for that. And it's something I'm trying to get away from. I feel like I'm trying to move away from convincing people to invest. I feel like what I really want to find are people who are committed to learning more about it. People who are saying, hey, I want to be involved in this. I'm not afraid to get started. I just want to learn how, right? Because I feel like there have been a lot of those people where, again, they've been on the fence or have been trying to sell them. Hey, look, you'd be so much better off in the market. They're like, oh, that sounds risky. All these different things. I'm trying to show them returns, try to show them, anything I could do. And I feel like, first of all, I feel like I haven't had a lot of success in converting those people. Again, I think a lot of the people that I have converted or kind of helped out have been people who, again, they want to learn, right? So, and I think it's kind of like that with anything, right? I mean, it's like, I think it's hard to get somebody who wants to go to the gym, but if you get somebody who's showing up every day and you're like, well, wait a minute, I see that you're doing these workouts, but have you considered changing this up? And I think if you did this differently with your form, I think those people are much easier to work with than somebody who's just sitting on a couch saying being in shape would be nice.
Right. Yeah.
So.
Agreed, man. There's a lot of work that goes into this. This isn't just although I will say this, one of the things that I do tell people about my thing is for a certain type of person who doesn't really have the interest in the market or the time, like if, for example, one of our members who's actually done fantastic is a very busy surgeon, really busy surgeon and businessman. So, he's running these centers and he's doing surgeries all day and everything. And he loves this because he does kind of set it and forget it. He just basically once a week checks and sees what moves, like what the portfolio is doing.
Yep.
He was saying sometimes he'll literally be like, just like getting ready to go into surgery or just coming out of surgery, and he'll get a thing on his Apple phone or his watch, his Apple Watch, that'll just basically say you have an email trade alert, and he'll see that I made a trade, and he'll be like, and he doesn't even really kind of question it because he's not that into it. He just makes it, and he just figures, I'm just going to mirror this guy's portfolio. He knows me. He trusts me. I'm going to mirror his portfolio and that way I don't have to put a lot of time into it because I don't have a lot of time to put into it. And that's okay. Some people are doing that and that's good for them. And other people, I say, learn to do what I did and make it your own. I mean, you don't have to do exactly what I do. You can bring ideas to me. I mean, I love, one of the things I love is we have a private Facebook community too, where everybody shares ideas, and there's for example, I'm not invested in cryptocurrency right now, but some of our people, we got some younger guys like in their 20s, for example, and some guys in different countries too, who are very into crypto. And it's great because they teach me stuff all the time. And, they make me a better investor just learning. Right. And that's what we're all trying to do is trying to make each other better by bringing something different to the table. I mean, we're not all copies of each other. We're not all robots saying, hey, we can only do high growth tech. That's my thing. That's what I do, high growth tech, because I'm passionate about it. I love it. I understand it. I even work in it. So, so I have these conversations all day, every day. And I believe if you invest in what you know and what you love, your chances are you're going to do a lot better than if you're just investing in something. Like for me right now, one of the reasons I'm not in cryptocurrency right now is because even after reading a great book about it and watching a lot of webinars and everything else, do I understand it from an overarching? Yeah, I understand the concept of blockchain and I can explain it to somewhat. But when my father, who knows nothing about blockchain and nothing about cryptocurrency, asked me to explain it, I do not feel confident really explaining it and why it's a great investment and why it's going to replace, other forms of currency or other technologies. And if I can't explain it yet, I shouldn't be investing in it. That's what I tell the people in my look. If you can't fully explain your reason for being invested in this and why it's a smart investment and what the risks are and what the competition is, you can't fully explain all that, you shouldn't be invested in it. So anyways.
No, I think that's great. And for me, I feel like I always encourage asking, it's as simple as two questions. I feel like it's really making sure, one, what do they do? Which sounds straightforward, but there's people who invest in companies and they don't know how they make profit. They don't know what they do. So one, being able to explain to somebody, what does the company do? Okay. And two, explaining why you want to own it. Because just because, you know what they do doesn't mean it's a good investment, right? So I feel like, and part of that, I think the second part of that question is making sure it's a good valuation. And I feel like that to me, that's such an underrated piece of it. And I want to circle back to crypto a bit here because I've got some opinions on that as well. But for me, I think one of the biggest things that, holds back investors is not kind of being aware of some different valuation techniques. And I think part of the problem is I think valuation can be, if you get really deep into it, can be a really complex topic, but you can also kind of approach it from a more simplistic point of view. And really what I like to do with valuation is I like to basically be able to state what has to happen to the company in terms of, let's say, sales growth, profit growth. So, again, I was looking at Duluth. I made good money with them. I was looking at them, and historically, they were growing by double digits. They had, with 2020, they, were able to actually, even with stores being shut down, they were able to shift enough online where they didn't just, kind of maintain their sales. They grew their sales year over year by driving more to e-commerce. So I love that story. And then again, when I looked at it, I was modeling out that, to get to my valuation, I think I was buying them at $11 a share. My target price was $18. And to get to that $18 target price, it was going to imply that they needed to grow their future revenue by about 4%. So again, they were previously growing it by double digits, had the e-commerce as a tailwind, had all these reasons to kind of be set up for success. And so when I'm able to put it in those terms, when I'm able to start to think, okay, do I think that they can grow by more than 4%? Yes, they're probably going to grow closer to 9, 10, 11% a year, right? So it's like, you know what I mean? So when I can sort of think that through, put that into, real world context, I feel like it gives me a lot more confidence, in the valuation. And on the flip side, this is something I feel like I also try to stress is that there could be a company that I could tell you is going to grow their sales by 200%. But if their price implies that they need to grow by 600%, it could still be a bad investment.
Right.
So I think it's kind of important to kind of keep all those things in play. And I think, because some people, I think Tesla's a good example. I think Tesla has certainly at different points at least kind of gotten a little ahead of itself in terms of valuation. And I think that sometimes people have just been buying the story more than they've been buying the actual fundamentals or actually buying into, kind of what makes sense with that. But
yeah, no, it's a good point. I mean, I think that I also look at valuation. It's not, I would say that my valuation's not my number one thing, but it's probably number two or
yeah.
number
and
three.
it's harder with tech for sure. Because a lot of tech, it's valuing future revenues.
I'm looking first at growth. I'm looking first at how fast the company is growing revenues. I don't care that much about earnings because if you look, earnings used to be a big deal, and actually earnings are still a big deal in other sectors. But if you look at tech, I mean, really, Amazon was really the first company that kind of really turned everything on its head. Amazon didn't have earnings for the longest time, and people were saying, "Oh, it's going to crash." Where's the earnings? But meanwhile, what you learn when you study a little bit, you read about Amazon is Jeff Bezos was a genius, right?
Yeah.
They didn't have earnings and they had huge revenue, but no earnings because he was taking that revenue and investing it back into R&D for future growth, for continued future growth. And that's become a model that I look at. And it doesn't mean that I don't care about, I do eventually want earnings. I want to see what the path to earnings is, but it doesn't have to be immediate for me. So I would say that I'll clarify a couple of things. First of all, I'm not great at math. I'm not an analyst. And I pay for research. And I will tell you, I really believe that money spent on great research is money really well invested. I will tell you that I probably spend between $8,000 to $10,000 a year on research.
Yeah.
And when I look at my return off of, how that research has helped me to make the selections that I make, and to stay away from certain selections too, and when I look at the return on investment is so huge. So I think a lot of people, when I tell them that that's what I spend on research, they're like, whoa, what are you, crazy? And then when I tell them how much, that $8,000 that I spent in 2020, and yet my portfolio was up, my portfolio was up somewhere in the neighborhood of like $600,000 to $700,000 on an $8,000 investment. So anybody would do that.
You can justify it.
Anybody would want that ROI,
Absolutely.
And I can honestly say that if I didn't have that research, I know for a fact my ROI wouldn't be anywhere near that good because I am not an analyst and I'd have a really hard time trying to analyze these stocks myself. So for me, it's kind of a no-brainer. I'll start with that, but I pay attention to what my research tells me about valuation. And I'll give you one example of where I do look at valuation. So I know SPACs are very out of favor right now and a very controversial, topic,
yes.
But
a lot of them too.
I have several great SPACs that I love, and I know several SPACs that I can't stand because SPACs are like anything else. You got some really bad ones. And you got some great ones that are, and right now the whole basket of SPACs is pretty undervalued in my opinion. So there's some opportunity there. Just like 4 months ago, the whole basket of SPACs was overvalued and there were some really bad companies that were way overvalued. Now you have the opposite. The pendulum has swung in the other direction, right? So 2 weeks ago, I bought a new SPAC, or a new SPAC for me. And just to go into valuation a little bit and how it plays for me. So for me, the first thing I looked at was the story. I love the story behind this company. They've got I look at different things. I look at the moat, using the Warren Buffett moat thing, and they've got a huge moat. I mean, I don't want to say they have no competition, but pretty much they're like the big dog, right? They're in a field that is growing and is anticipated to grow a lot more in the next 5 to 10 years. They've got multiple levers to pull. There's a blockchain lever that they can, that if blockchain continues to, really become a big thing, that could really even put them into hyper growth. But even without that, they're growing. So we're talking about double-digit growth, high margins, right? Yep. And then, so I looked at all that, and then I took a look under valuation because, when my research always goes into the valuation and valuation. They are currently when I bought them 2 weeks ago, a $1.2 billion market cap, right?
Okay. So still pretty small.
And last year's sales, 2020 sales, 567 million. Two times last year's sales.
I'll take for a tech. With that kind of growth.
For a growth company, 2 times last year's sales. Oh, and then the final piece, I really pay attention to leadership. I could have all the things that I just said, and if I don't if there's nothing impressive about their leadership, I probably won't buy them. I have a very stringent thing. There's a lot of great companies that I don't own for one of these reasons or another. This company has one of a heavyweight giant as their chairman CEO. So boom. So check all the boxes, bought it 2 weeks ago, and it's up 30% in 2 weeks. I mean, and again, short term, that's great. I'll take it. But what I'm looking at is what that's going to do long term.
Yep.
I love it. So yeah. So anyway, point being, I pay attention to valuation. And then you had also mentioned, we were talking about, about growth. Yeah. I don't know. I think I hit on,
Yeah,
might have
absolutely.
been one other thing you had mentioned that I wanted to go over, but I forget now.
Well, we can come back to if you think of it, but I
Sure.
did want to circle back on crypto because I can tell you that with cryptocurrency, I have completely missed the boat on that. But I can
Mhm.
tell you that that's something that I feel like I've been very comfortable missing the boat on because I'm, just like to me, like you said, I feel like if I was going to explain the actual value, of saying that like, we have a problem with payments and we need to be transacting with Bitcoin or Doge or whatever it
Mhm.
is. I don't necessarily see that as being like something that people are using from like a practical standpoint. I feel like the only thing I hear people buying cryptocurrency with is the expectation that the price is going to go higher, right? And I
Right.
feel like when somebody's only interested in buying something because they think the price is just going to keep going higher, and that's the sole basis for buying, I feel like I'm a little nervous about that. And I feel like even understanding, the source of where some of these things are coming from. So the fact that it's kind of murky about the genesis about Bitcoin and some of these things, right? So that has me a little bit concerned. And then of course, the idea, and I think we saw a little bit of the price kind of being hit from this, but the whole idea of regulation is the whole idea that I think if the US government really decides that they wanted to say they want to crack down on it or find a way to basically, all but eliminate it, I feel like they could have the resources to do so, and I think that, to me, again, it sure would have been nice to be one of the guys who, you had $100 in Bitcoin 10 years ago, but I feel like to me, I feel like I also try to, judge myself based on the expectations, kind of that I had before the event and not what happened after the event. To me, it's almost like if you play poker, you hear some guys, if you fold 2-5 and then the flop comes 5-5-2, you say, I knew it was going to be 5-5-2. And it's like,
Mhm.
well, no, you still have to go with the expectations. It's still a horrible starting hand, right? So it's like
Right.
you can't just beat yourself up because you would have hit the lottery, right? You kind of got to go by, kind of in my opinion, a little bit more of a rational approach. So
Yeah, no,
again,
you're making good points. I mean, I come at it from a little bit of a different angle on the future of it and especially the regulation piece. So I've been on some really interesting webinars where I've actually heard several officers and commissioners from the SEC talking about Bitcoin in a very
okay,
positive light, by the way.
okay,
And what I am hearing and what I think you're going to see is that there's going to be some regulation. Most You're seeing a lot of huge institutional money flowing into Bitcoin, right? And it's not just Elon Musk and Tesla, it's money from every company from IBM and Microsoft and
yeah,
governments and Fidelity. I mean, Fidelity, obviously, they filed with the SEC they want to do a Bitcoin ETF. You're going
mm-hmm.
to see all of them, Vanguard, Schwab, they all want to get into, well, they are getting into, but they want to get that Bitcoin ETF to make it easy for people to buy Bitcoin, because one of the things that holds retail investors out of Bitcoin is the fact that it's not as easy to buy as stocks right now.
Yep.
When it does become as easy to buy, I think a lot of money is going to flow into it. I think the price will eventually go up a lot. And I don't think that's far away. As far as regulation goes, and I'm just telling you what I heard from some SEC folks, they actually think that regulation of Bitcoin will be a good thing for Bitcoin itself, because it will make it that much more predictable, reliable.
That's true. More legitimate.
It'll make people, more legitimate, make people more comfortable with Bitcoin. And people are becoming a lot more comfortable with Bitcoin. If you look at it, I saw this in the webinar too, that the volatility, the beta on Bitcoin used to be obviously so high. It's gotten lower and lower every year, to
Hmm.
the point now where Bitcoin is actually less volatile than lots of tech stocks that are well-known names,
That's
actually.
interesting.
Yeah, it's very interesting. Yeah. So yeah, I mean, and with Gary Gensler now approved, with Gary Gensler now the head of the SEC, someone who taught a famous course on Bitcoin and blockchain at MIT. I think that Bitcoin is going to have a place. I really do, and I see big institutional money going into it.
Yeah.
I just think that what needs to be weeded out is there's still a lot of shady stuff going on with Bitcoin. And what I don't mean like at the high level. I mean, like if you go on Facebook, I don't know about you, but I must get 10 friend requests per day on Facebook
Oh,
from
yeah.
people
Yep.
that are like Bitcoin mining experts that want to teach me how to mine Bitcoin and show me
Right.
how to make $10,000 a week. And that stuff is all scam and everybody knows it.
Yep.
And as long as there's that type of thing going on, what's going to happen is I think Bitcoin's still going to have times where it crashes. They need to get rid of that somehow. And so my whole thing is, look, you can't be, whether it's cryptocurrency or just stocks in general. I try to tell the people that are in my thing, we don't want to own 100 stocks. We don't want to have an ETF and own 100 different stocks.
Yep.
We want to be concentrated. We own about 35, I think, stocks, and 35 to 40 stocks in our portfolio. And that's a number I can live with. We've been as high as like 70. I didn't like that number. So we, cut it down. But the point is, we are not going to try to own every stock. And we are very comfortable with the fact that we know, in fact, that we are going to turn down stocks and say, no place for it in our portfolio, knowing that stock will probably be a big winner. And I will tell you that I don't own Apple. I don't own Google. I have in the past, but I got rid of Apple. I got rid of Google. I got rid of Amazon, not because they're not great stocks, but because I only can hold so many stocks. And we decided at recently last year that our goal now is 10x returns, or the potential for 10x returns, the real potential for 10x returns over the next 5 to 10 years. And as great of a company as Amazon is, and I love Amazon, and I think Amazon is going to continue to grow. I think it'll probably double in the next 5 to 10 years. I'm actually pretty sure it will. But I don't think Amazon is going to 10x in the next 5 to 10 years. It would be amazing.
I mean, it's hard to 10x when you're at $2 trillion.
If any company can do it, it's Amazon, right? But I don't see it. I'll give you a perfect example. This is a good example of how I think when it comes to valuation and inclusion in our portfolio. And I can mention this stock because it's on our radar, but it's not in our portfolio. Nvidia, one of my favorite. I think it may be the best company in the world. That's a very broad and subjective statement, but Nvidia, if you look at all the trends that it's right at the leading, leading in all the big trends that are everything from electric vehicles, autonomous driving, right, gaming, AI. I mean, Nvidia is at the leading edge of all of them, right? It's pretty cool, right? They've got an incredible CEO who's run the company like as good as, I'd put him up there with a Steve Jobs type of guy or a Bezos. Jensen Huang, incredible, right? And their performance as a company and as a stock has been out of this world, right? So literally checks every box. I will tell you that I bought that stock when I started managing my portfolio in 2018. It was one of the initial stocks that I bought. I got it under $100. I got it in the 90s, right? And I wrote it and I added on to it all the way up until last year. We sold it about $600 a share.
That's great.
Yeah, great return on it. And when we sold it, the reason we sold it was the valuation is right about what it is now, about $330 billion, right? Now, that's a tough one because I will tell you that, put it this way, could Nvidia be a $3 trillion company in 10 years? It's possible. But again, if we're only going to have 40 to 50 stocks, let's say, in the portfolio, there are other stocks that have legitimate, really like better chances of not only being 10x, but we're talking about 10 to 100x. If some of these ones that are like billion to $8 billion market caps that are really great companies.
Yep.
Yeah, they have much bigger potential. So that's why we sold Nvidia. We sold it at a high. We took our profit and we put it into companies that we felt were, better long-term exponential growth investments, right? So the reason I bring up Nvidia, because I just recently put it on our radar again. And the reason why is I don't know how closely you follow it, but they made a big acquisition, which hasn't gone through yet, but of a company, a SoftBank company called ARM or ARM, which is like a big thing in the semiconductor space. It's a huge strategic move and it's very controversial. Like I know that AMD and Intel and the other semiconductor companies aren't happy about Nvidia acquiring ARM because Intel and AMD are, they need to do business with ARM, which means they'll need to do business with Nvidia, who's a competitor of theirs. So very, very complex, right? Whole thing. Anyway, the bottom line is that I think last week some news came out that, well, first of all, last week, Nvidia announced earnings. And I think they announced earnings, or was it just they got some great news? I forget. I'm not 100% sure, but Nvidia got some great news basically. And the stock like took off. I mean, like it really took off, hit a new all-time high. And then a couple of days later, like I think Thursday or Friday, came news that there's going to be some regulatory hearings over this acquisition. And you and I both know that anytime something like this happens, when people hear the news, they sell on the news, or they sell on the rumor, right? They're, oh man, and they always think the worst. There's always overreactions. In my experience, there's a really good chance that this ends up being nothing and the acquisition goes through. And even if it doesn't, Nvidia has so many ways to win without the acquisition. It's like, I don't really think it even hurts them long term.
Right. It's like the acquisition's gravy if it happens, basically.
The acquisition's gravy, right? So what I told the people in our group is, look, this is on my radar because it doesn't quite make the cut in our portfolio at $330 billion valuation. But if it were to lose, if it were to lose like 30% of its market cap, that company, Nvidia, at a $200 billion valuation, even though that would make it the highest, valuation company in our highest market cap company in our portfolio. But I really do think that they're going to be a $2 trillion company 10 years from now. I really do. I mean, Apple's a $2 trillion company now. I think Nvidia 10 years from now is a $2 trillion company. And so and it would be nice to have, it would be certainly a lower risk stock than some of the other smaller cap stocks in our portfolio. So yeah, that's just an example of kind of how I look at it. Yeah. And also just, I love talking about that company. It's a great company.
Yeah, no, again, a lot of success with that company. And again, when you bought in for less than 100 and you're able to sell at 600, you have every reason to want to talk about it.
Right.
But yeah, I can tell you my relationship, a story here with Fubo. So with Fubo TV, I remember it was kind of like around last fall or winter, that stock started to really take off. And, I was kind of starting to look in when they were like in the low to mid 20s. And based on my calculations, I was kind of coming up with, and I tend to be fairly conservative with my numbers. I feel like I want to be pretty confident that I'm going to be getting a good value. So I was thinking that they were going to be, based on my calculations, worth about $25. Well, again, like they were really starting to take off. And I feel like I even kind of had a video out there walking through the valuation. And, I watched them go from the $25 all the way, I think it was north of 60 for a while. Okay. And first of all, I can say, if there's ever a stock that gets away from me, the good thing about stocks is there's thousands of them. So just because one gets away from you, or just because crypto gets away from you, doesn't mean that there's not opportunities out there somewhere else. So I was able to find opportunities somewhere else. And then just last week, I noticed it popped up on my watch list that it was $17 and change. And I said, okay, wait a minute. This is a company, and like you said, I think a lot of tech was just unfairly they were kind of throwing the baby out with the bathwater, and it was kind of the good and the bad was being oversold. So that was a company that when I saw that at 17 and change, I was able to pounce on that one. And I think even just since then, I think it's up, mid single digits or maybe even as much as 20% since then, So I think being aware of the price that you're willing to pay, right, and kind of keep continuing to monitor that, I think is really huge too, because I think, if in calm times, when there's not a lot of volatility, if you're able to kind of put your shopping list together, then know the ballpark that you're willing to pay, then all of a sudden if the market does tank, you can kind of take a look back and say, okay, is this in my range now? But then also understanding if anything changed with the story, because also, you could have something where stock is lower, but maybe there was this really substantial accounting issue, or a founder was leaving. If there's something that's going to change the investment thesis, maybe you got to go back to the drawing board a little bit. But if the only thing that's changed is you're just getting the same story at a better price, I think that, it's good to keep those on the radar. And speaking of, like, what's your approach? How do you keep track of your watch list, by the way? I know for me, I can just tell you quick, what I've kind of come to do is I've got an Excel spreadsheet that I have a column for what I think the value is worth. I've got a column that automatically updates the price, every day for me. So every day I can kind of go in and say, if there was a stock that I thought was worth 25, it was 30, and now, it's 17, like in Fubo's case, I can kind of just sort real quick and get to that. So that's a bit of my approach, but how do you keep track of your watch list?
Yeah, sure. So I'm not quite as technical. I probably don't have, I know I don't have your, probably your background on that. So what I do is literally more of a, like I said, I do two things. I'm literally old school with a notebook and a pen, and just basically writing down the stocks that are on my mind. And then also, I'm also, putting them one a week goes in as their stock that's on our radar in our weekly wealth report. So I have that. I can access all of those. And basically what I do though is I enjoy reading about, what's going on with different companies. So when I'm looking through the research that I pay for,
Yep.
I check the companies on the watch list. I don't check every one of them every day, but I'm not somebody, and that's another thing too, is I don't believe in watching the market too closely. I think you can watch the market too closely and just start, you're almost watching it so closely that you're missing things. It helps to, I think, have a little bit, I might be looking at them more like once a week,
Gotcha.
kind of evaluating them once a week.
Yep.
And just kind of seeing if anything's changed. You brought up an interesting thing with Fubo, which is a really interesting company because it's very controversial, meaning that you got people that love it. It's a very polarizing company, Fubo, right? You got bulls that love it and you got bears that hate it. And they can both make very convincing arguments. And one of the nice things about spending time in the market, like literally, like really, doing your homework, reading a lot of different research and things like that, is you start to, the more time you spend in the market, you start recognizing patterns and familiar things. So like, for example, with Fubo's been the victim of some pretty serious short seller attacks, right?
Yep.
And the nice thing about having time in the market is, well, I've seen some of those same companies. You get to even, recognize the names of these short sellers, right? And I've seen some of these same short sellers do similar things over the last couple of years with other companies and have the price go down when the short selling report came out. But eventually if it was a good company, it ended up winning the day. And those short sellers ended up covering their positions and buying and driving the price up even more. And so, you get to start recognizing that type of thing. I like Fubo a lot. I think that it confuses a lot of people. One of the things that happens with the market is, I find anyway, is that even some of these big name analysts, they really look short term. They have to, because they're being judged short term, right? All the big banks, all the big institutions, and the big hedge funds, they are judged on an annual, if not quarterly basis. Like if it's a hedge fund basically, and they have a bad quarter, they may lose, clients. They have a bad year, they're almost certainly going to lose clients. So they need to, as individual investors, you and I, is we don't have that pressure. We don't have to think short term. We have time on our side. We can wait for a thesis to play out. And because of that, so I bring that up in the example of Fubo. So Fubo is an interesting company. If you're just valuing it on what they bring right now and what they might bring in the next year or so, you might say they're overvalued. You might say they're overvalued, and that's, I think, what a lot of analysts are doing. But if you factor in what they're trying to do with online betting and being able to work online betting into their platform, as well as other things too, then they become really interesting. And the truth is that analysts don't know how to value that yet. They can try, but we don't know how big that could be. And so, I think you don't do this with every company, but if you like a company like Fubo, you also sometimes got to take a little bit of a leap of faith and say, I think this could be huge. And I like the way this company is approaching things. You might even just say, look, I like the way this company is approaching things. They remind me, they're trying to be like almost like a Netflix type of thing for sports or whatever the case, streaming and, and the online betting, the online gambling piece. And you go for it and you hold it because it's going to be volatile. Like that stock is probably going to, at some point, come back down to 15, and it's probably going to be back above 60. And I see it being very volatile for probably like the next year or so.
Absolutely.
And then eventually it'll probably even out. And I do like it long term. I think it's a really cool company. Yeah.
No, and you brought up that interesting point, and I know that obviously there's been a lot of excitement and buzz around the online gambling stocks, and I think what I like about Fubo is that, let's say if you want to go place a bet with DraftKings or FanDuel or some of these other kind of platforms that you can use, there's still that question about where you're going to watch the game and things like that. So what Fubo has, if you're already there watching the game and it pops up where, hey, you can place a $5 bet if they're going to make this, free throw, if they're going to hit a home run, you're going to have that right on your smart TV or right on your app on your phone or whatever. I mean, to me, that's just seamless integration. And I think it makes a lot of sense because, again, it's like now all of a sudden you don't need to say, I'm going to place a bet where I'm going to watch it. You're going to say, oh, I'm already watching it and I'm going to place a bet, right? So I think it's a way to potentially bring in customers that you wouldn't have maybe had access to otherwise. You're going to have people who want to bet who are going to go there. So, and just like we were talking about with Nvidia with that acquisition, I also think you could make an argument that, at this point, you could start to justify the valuation, even if, the sports betting never, kind of plays out.
Right.
Their core business,
They're
kind of
growing.
makes sense to justify it. So again, I feel like there's a ton of upside if it works. And if it doesn't, it's not like they're going to go out of business because of it. So
yeah. Again, it's another one. It's another one, like I said earlier, where that's why in some cases I look at growth before so they're obviously they don't have earnings, but their growth is what I'm looking at. Like, in other words, an analyst could look at them and say they are way overvalued.
Yep.
And by certain standards, that analyst would be right, that they are overvalued. But if you love their growth, then a lot of times the valuation will catch up with the growth, or I should say the growth will catch up with the valuation and then surpass it. And if you believe that, and that's what you believe if you're investing in Fubo, you're not looking at the current, some of these valuations are pretty astronomical, you know what I mean? Right now, but again, that's what we pay for companies that can grow revenue like wildfire, right? I mean, and have high margins too, high margin. And I don't particularly know if Fubo does have high margins or not, I forget, but I know some of our investments too, where we're looking at the growth, and then some of our investments have 90% margins too. So, I mean, that's huge. And, then you get the growth and the margin and you're like, wow, this company is going to be so profitable eventually.
Like when they reach scale, it's going to be ridiculous.
Yeah,
right?
yeah, exactly.
And the other thing to keep in mind with some of the analysts too, is that, obviously it's not true for everybody, but some analysts out there, they've definitely got a conflict of interest in terms of if they're on the sell side, and they're, they might be kind of, working on the deal where they're selling a stock or at the IPO and telling you that it's worth, $100 or, whatever else, right? They've got every reason to kind of like have that relationship built up where they don't want to be insulting the company going public, right? So, and kind of vice versa. So again, some analysts are going to be super conservative and maybe they're not going to fully appreciate the growth like you're talking about. Some are going to have the conflict of interest. But that's why I think it just kind of goes back to, certainly if you have the time to understand some of the drivers yourself and kind of, right, which I think it doesn't have to be all that complex. You mentioned the sales, like that tech company that's in your portfolio, when you're like, hey, you got double-digit growth and they're, going at 2x sales, right? I mean, you don't need to be a rocket scientist to figure out that,
that's a great value.
An opportunity, right? You know what I mean? So I mean, it's as simple as saying, it's a pretty easy, like, how much are they selling for? What do they do, in sales per share, right? So pretty easy math. And again, when you start to get that context to be like, hey, a lot of those companies that are going to be doing that are going to be 10 or 20 times sales, right? So you can kind of start to put that into perspective a little bit. So
for sure, man. Where are you, by the way? What city are you in?
I live in Michigan.
Oh, you're in Michigan?
Yep.
Cool.
I live in Michigan. I'm actually kind of going through a transition. I'm going to be relocating to Florida later this year. So I feel like I don't know. I feel like I enjoy, the sun and palm trees on a more regular basis. So
great. I just got back from Florida a couple of weeks ago. You'll love it. It's what part of Florida?
We're looking at the Miami area.
Great.
I love it down there, and I feel like I love that balance between, you want to be in the city, you can be in the city, you want to be in the beach, you're not a far drive from that either. So
excellent, man.
Cool. Where are you at now?
Yeah, I'm in a suburb of Philadelphia, so I'm in the Philadelphia area.
Okay, gotcha.
Yeah.
So at least we have some nicer weather coming up to look forward to. But
weather's fine here. I'm not complaining. It's all good.
Hey, I also want to ask you, because I mean, it looks like you've got a strong entrepreneurial background, right? So I mean, like, can you talk about kind of really analyzing the leadership team? Like, can you tell me a little bit about, like, how that's with your entrepreneurial background, of course, kind of knowing how to run a successful business, how that's helped you to analyze some leadership and to kind of show some traits that you are looking for?
Yeah, sure. So I mean, I don't know how much my background as an entrepreneur has helped me in this as much as it is just, reading about it and learning how important it is and learning how to look for it. But yeah, so when I study research on a company, luckily one of the resources I use for research, they make a point of being, really delving into the leadership team, and they tell you how much inside ownership of stock, the leadership team owns, and not just the if it's founder led, or how long the CEO's been there, all that information, right? So it's really important to me. What I look for is, ideally a founder led business is great, right? Because founders tend to be the best at telling the story, be the most passionate about making sure quality is high, right? And then beyond that, I want a founder-led company where the founder, gets paid basically in stock, right? And they own a lot of stock in the company, because then our interests are aligned. My interests as an investor and their interests are aligned, as well as the senior leadership team. So, if the founder's not the CEO, I want the CEO, the CFO, I want this group all to have a good amount of their compensation being in stock. So yeah, I mean, and that's what I look for. I don't like companies where there's been recent turnover unless it makes sense. And the person, let's say that who was the CEO is staying on as the chairman, like in a Jeff Bezos type of situation. And the person who's coming on was running Amazon Web Services for the last 3 years and turned it into something incredible. That's fine, but it needs to be a story that flows. I don't want to invest in a company where, for whatever reason, the CEO stepped down and the new CEO is coming in from a different company. That's just too risky, I find. Also, I've sold companies recently where, just because for example, during the tech sell-off, one of the companies we owned, which I really liked, actually, I really loved the story of the company. Otherwise I wouldn't have bought it. But one of the companies we owned, I found out that the CEO and several other senior officers, CEO, CFO, and they sold a ton of stock when the stock was down like 40%. I mean, that's just common sense. Yeah. If the inside officers of this company are selling stock when it's down 40%, that's not a good sign. And so I sold. I like companies where they're buying their stock when it's down. I love that. If I can see a company that's buying its stock when it's down, well, they're not dumb. They're doing that because they believe it's going up, and that's sign of confidence. So yeah, that's a little bit about how I look at the leadership team.
Yeah, no, it's great. I mean, I can tell you, I don't know how much you followed JCPenney on their way down, but I can tell you that they brought in the CEO. I think he had I believe he was coming over from Apple, right? So again, different industry. And he said, okay, I know JCPenney does a lot of promotions, and they're like, your customer, let me tell you what you want, even though he's obviously new to the industry. He says, your customer wants an everyday flat price that's fair, no promotions, no 40% off, none of that stuff, right? Just a flat, fair price. And customers hated it, right? So again, that's somebody kind of coming in, didn't know the industry. And then, Kohl's was still in the mail saying, hey, we'll get you the BOGOs, your buy one, get one free, all that good stuff. And they kind of the customer said, hey, we like our deals. We're going to go to the Kohl's. We're going to go to the Macy's. And people basically backed away from JCPenney. And again, to your point, that was a leadership position that somebody coming out of the industry, didn't come up with the company. Yep. And again, I think that you can avoid some of those kind of more perilous situations by, being aware of what leadership's doing, what their background is. So.
Absolutely. Yeah, I agree.
Great. Well, that kind of is it from my side of the questions. Is there anything else you want to kind of, give a shout out with that you have going on, or for your group or anything, or?
Sure. Yeah. I mean, that would be great. First of all, I want to thank you for having me on. It's always, I love talking about this stuff. And I think that people like you and I that enjoy talking about this, that's why we're successful investors, because if you don't enjoy it, like I said, you probably shouldn't be investing a lot of money in, or you do it in a very, what am I trying to say? In a very low risk type of way, like a S&P index fund or something like that. But I enjoy talking about this. So do you, obviously. And these types of conversations make us better investors. I learned something from you, you learned something from me. And what I'll just say about my thing, for anybody who's interested, is this is, it's called the Exponential Investors Club. And it really, to me, it really is an educational service. It's a way for someone to, and we have experienced investors, we have CPAs, we have financial advisors in our group, which is great, I think, because again, it just makes our conversations, in the private Facebook community that much more interesting. But a lot of our people are people that just really wanted to learn about stock market investing. So anyway, anybody can check it out. The website's very simple. It's adamfiore.com. My last name is Fiore. And if you go to adamfiore.com, that's actually kind of like a bio page where you would see how you could link to the Exponential Investors Club and get more information about that. And it's not just click here if you want to buy. There's like a 15-minute video explaining everything that comes with it. So it should answer all your questions. And there's also testimonial videos from, we have everything from Fortune 500 executives to, like I said, a surgeon, and a couple of those people give testimonials as to their experience with us. But also on the page, if you go there, is, I have another business. Like I said, I'm an entrepreneur, and I have an online course for redefining what aging and illness can look like, because I was diagnosed last year with diabetes at the age of 51 and decided to, forego medication and insulin and try to do this myself. And I've been able to do it. I came up with a modified keto diet that's been incredible, a weight training exercise program, and just mindset meditation type techniques that have all come together to help me really redefine what aging, what diabetes can look like at 52. So I put that out there because if there's anybody out there that finds that type of thing interesting, or hears that and says, I'd like to look younger for my age, or feel better with whatever illness I might have, check it out. Because if you go to adamfiore.com, you can also click on the link that'll take you to that course, and you can learn more about that and see if it's something you're interested in. So that's just a little bit about me and the things that I do. And again, I appreciate you giving me a platform to maybe reach some new people and help some new people. And happy to come on with you anytime, because I really enjoyed the conversation.
No, I did as well, and I absolutely appreciate your time. And like I said, I'm hoping that there's going to be some people that are going to be inspired by your story. I think it's a great story. Again, I've seen some of the pictures you've posted. Clearly you are in great shape, so it's like, I love people who, are kind of walking the talk, and kind of out there living it, not just kind of preaching and that sort of thing. So obviously you're a great example of that. And again, if you're going to get rich in the stock market, you might as well be healthy enough to enjoy it, right? So I think those two things go together pretty well. So
absolutely. Well, again, thanks so much for the opportunity, and best of luck with everything, with the move to Florida and your investments and everything. I'll be following you as well.
All right. Same to you. Thanks so much, Adam. Enjoy the rest of your day.